Are assets outside the will free from inheritance tax? Now, this is a query I get all the time. And it usually comes down to one idea. People think that if something isn't in the will, it avoids inheritance tax. Unfortunately, it doesn't. Inheritance tax applies to the benefit received, and benefits arrive in many forms. Through a will, by nomination, through co-ownership. The most common assets that pass outside the will are joint property, joint accounts, and pensions. For jointly owned property, people think it's joint, so it moves across to them, no tax. What actually happens is that through survivorship, the share of the person who died moves to the survivor. It never touches the will, it never touches probate, but the survivor still receives a benefit which is taxed. Here's a tip though. Most people overlook ways to reduce the value of jointly owned land and buildings. For bank accounts, people assume the surviving holder already owned the lot. They didn't. Revenue looks at who put the money in. If the person who died funded the account, the survivor receives a taxable benefit. In some cases, the benefit is treated as having arrived earlier, so make sure to record the purpose of the account when opening it. For pension, lump and life assurance payments, trustees decide who gets the money. Pensions don't enter the estate and they don't appear in a will, but the person who receives the lump sum still receives a benefit and it's taxed. Plenty of assets move outside the will. Some avoid probate, some never touch the estate at all. But don't get caught out. Remember, legal advice is not tax advice. If you don't take tax advice, you're overlooking ways to reduce your liability.